Most people think debt is dangerous, and sometimes it is. But inside the architecture of modern wealth, something strange appears. The people with the most assets often carry the most debt, not because they are reckless, because they understand a mechanism most people never see. A quiet difference between two numbers: return and interest. That small gap quietly builds fortunes. And once you see it, the entire system of leverage investing becomes obvious. But until you see it, the whole structure looks irrational. You might even think wealthy investors are behaving irresponsibly, borrowing money, buying assets, holding debt for decades. Yet somehow their wealth keeps expanding. The explanation begins with a simple contradiction. Most people are taught to eliminate debt as fast as possible. Pay off loans early. Avoid borrowing whenever possible. Live debt-free. That advice sounds safe. But safety and wealth often follow different rules. Because wealth is not built by eliminating capital. Wealth is built by controlling more capital. And this is where leverage enters the story. Leverage simply means using outside money to control assets. Not spending money. Controlling assets. That difference changes everything. To understand why, imagine two investors. Both want to buy an income-producing asset. Maybe a property. Maybe a business. Maybe a portfolio investment. The numbers reveal the hidden structure. Investor 1 uses only personal money. They invest $100,000. The asset generates 8% annually. After 1 year, they earn $8,000. Plain and simple. Now meet investor 2. They invest the same $100,000. But they also borrow $300,000. $400,000 total investment now controls the asset. Assume the asset still produces 8% annually. That means $32,000 of annual return. But the borrowed money has a cost. Assume the loan interest rate is 4%. 4% on $300,000 equals $12,000. The asset generates $32,000. Interest costs $12,000. The difference remains. $20,000 of net return. The investor originally invested only $100,000. But the return was $20,000. 20% effective return. The asset itself never changed. The return rate never changed. The only change was leverage. That difference between asset return and interest cost quietly multiplies wealth. This is the return versus interest secret behind leverage investing. And once you see it, something deeper becomes clear. Debt itself is not the real variable. The spread between return and interest is the real variable. When the spread is positive, leverage can amplify wealth. When the spread turns negative, leverage becomes dangerous. That is the entire mechanism. But the implications run much deeper. Because leverage does not only multiply returns, it multiplies control. And control of assets is where long-term wealth emerges. Imagine another example. Two people want to build a portfolio. Each has $200,000 available. The first person avoids debt completely. They invest $200,000 in assets returning 8% annually. After 1 year, the portfolio generates $16,000. Solid growth. Now imagine the second investor follows a different strategy. They invest $200,000 of personal capital. But they also borrow $400,000 at 5% interest. Total assets controlled become $600,000. Assume the portfolio still earns 8% annually. 8% on $600,000 equals $48,000. Interest cost on $400,000 at 5% equals $20,000. The net result remains $28,000. The first investor earned $16,000. The second investor earned $28,000. Both started with the same capital. Both bought assets producing identical returns. But leverage changed the scale of the outcome. Now pause for a moment, because this reveals the first wealth shock. The real difference between wealthy investors and average savers often begins here. Not with higher intelligence. Not with secret investments. Simply with the controlled use of external capital. And that capital is usually debt. But the story goes deeper. Because leverage also interacts with something even more powerful. Asset appreciation. Assets do not only generate income. Many assets also rise in value over time. Real estate, equity portfolios, businesses. When appreciation enters the equation, leverage becomes even more powerful. Consider another simplified scenario. An investor buys a $1 million asset. They invest $200,000 of personal capital. They borrow $800,000 from a bank. Assume the asset appreciates 5% annually. After 1 year, the asset value becomes $1,050,000. $50,000 of appreciation occurred, but the investor only contributed $200,000 of personal capital. That $50,000 gain represents 25% growth on their equity, even before considering income. Leverage amplified the effect of appreciation. This is why leverage often appears in real estate investing. The asset both produces cash flow and appreciates, and the borrowed capital allows control of a larger asset base. But something else quietly happens in the background. The loan balance slowly declines. Every payment reduces principal. So over time, three wealth drivers operate simultaneously. Cash flow, appreciation, loan reduction. Each factor compounds the others. And leverage makes all three operate on a larger asset base. Now the mechanism becomes clearer. Leverage is not primarily about borrowing money. It is about expanding asset control beyond personal capital. That control creates the possibility of accelerated wealth accumulation. But the story still is not complete. Because wealthy investors rarely sell appreciating assets. Instead, they often do something else entirely. They borrow against them. At first, that sounds counterintuitive. Why borrow if the asset already generates value? The answer again hides inside the structure of the financial system. Selling assets often creates tax obligations. Capital gains become taxable income. Borrowing against an asset does not create taxable income, because loans are not income. They are liabilities. So an investor might hold an appreciating asset. Its value increases year after year. Instead of selling the asset, they borrow against its value. The borrowed cash becomes available without triggering asset sale taxes. The asset continues appreciating. The investor continues controlling the asset. And the borrowed capital can purchase additional assets. This is how leverage becomes a repeating cycle. Asset acquisition, cash flow generation, asset appreciation, borrowing against increased value, new asset acquisition. Each cycle expands the portfolio. But this only works under one condition. The return must exceed the interest cost. If that relationship reverses, the entire system becomes unstable. And this leads to the second wealth shock moment. Debt itself is not the primary risk. The mismatch between returns and interest is the real risk. If interest rates rise above asset returns, leverage begins destroying value. if asset income fails to cover loan payments, the system breaks. This is why disciplined investors constantly monitor that spread. They focus less on debt size, more on return versus interest. And they structure investments where the asset itself supports the debt, meaning the asset produces enough income to service the loan. This concept is sometimes called self-financing assets. The asset pays for its own financing. The investor maintains control while the asset gradually strengthens their position. But something even more subtle occurs over time. Inflation quietly shifts the mathematics. Imagine borrowing $500,000 at 4% interest. That interest rate remains fixed, but inflation reduces the real value of the debt. If inflation averages 3% annually, the real cost of the debt becomes minimal. Meanwhile, the asset value may continue rising with inflation. So over time, inflation actually reduces the real burden of fixed debt. Another quiet advantage of leverage. Now consider a long-term scenario. An investor controls assets worth $2 million. Half the value is financed with debt. The assets produce 6% annual returns, $120,000 per year. The debt costs 4% interest, $40,000 per year. The difference remains $80,000 annually. But the assets may also appreciate over time. Even modest appreciation compounds dramatically across decades. This is how leveraged portfolios slowly expand wealth beyond the original capital. But now a different insight emerges. Leverage is not about taking reckless risk. It is about structuring capital flows intelligently. The wealthy rarely think about money as static savings. They think in terms of capital efficiency. How much asset value can this capital control? How much return can this asset generate? How much does the borrowed capital cost? Those three variables form the entire equation. And once the equation works, the system becomes scalable. Because assets themselves create future borrowing capacity. Banks lend against asset value. As asset values increase, borrowing capacity increases. More capital becomes available. More assets can be acquired. The cycle continues. But this leads to another realization. Ownership is not always the primary goal. Control often matters more than ownership. If an investor controls a large asset through partial equity and structured debt, they still benefit from the asset performance. Control allows participation and growth without providing the entire capital personally. This idea runs directly against traditional financial advice. Most people focus on eliminating liabilities. Wealth builders focus on expanding asset control responsibly. Again, the critical variable remains the return interest spread. Now imagine a small thought experiment. Two investors begin at the same starting point. Both have $150,000 available. The first investor avoids leverage completely. They invest their capital in a diversified portfolio returning 7% annually. After 10 years, the investment becomes roughly $295,000. Steady progress. Now imagine the second investor uses moderate leverage. They invest the same $150,000. But they borrow another $150,000 at 4% interest. Total portfolio becomes $300,000. Assume the portfolio still returns 7% annually. 7% on $300,000 equals $21,000 annually. Interest cost equals $6,000 annually. Net gain equals $15,000 annually. Over time, the compounding effect becomes significant. Because the second investor controlled a larger asset base. And that base compounded across the same time period. Again, the asset return never changed. Only the capital structure changed. Now pause again. This reveals something important about modern financial systems. Banks themselves operate on leverage. Deposits become the foundation for lending. The system multiplies capital through credit creation. Large corporations operate similarly. They issue bonds to finance asset growth. Governments finance infrastructure through borrowing. Leverage exists everywhere in the financial system. The difference lies in discipline. Disciplined leverage expands wealth. Undisciplined leverage creates collapse. And history shows both outcomes repeatedly. Financial crises often emerge when leverage expands beyond the capacity of assets to support it. Interest costs rise. Asset values fall. The spread reverses. The system destabilizes. But inside well-structured portfolios, leverage remains controlled. Investors select assets carefully. They evaluate stable income streams. They maintain safety margins between return and interest cost. And they avoid excessive leverage ratios. Because leverage amplifies outcomes both directions. Positive spreads accelerate growth. Negative spreads accelerate loss. This is why leverage is considered powerful but dangerous. It magnifies whatever already exists. Strong assets become stronger investments. Weak assets become catastrophic mistakes. So the real skill behind leverage investing is not borrowing money. The real skill is asset selection. Assets must generate reliable returns. Assets must produce consistent income. Assets must maintain long-term value. Only then does leverage function as a wealth engine. Otherwise, it becomes a liability trap. But when executed correctly, the architecture becomes remarkable. External capital expands asset control. Assets generate income and appreciation. Debt remains fixed or gradually declines. The investor equity portion expands over time. And the difference between return and interest continues compounding quietly. That difference is the hidden engine of leveraged wealth. A small numerical spread creating massive long-term consequences. Now step back and look at the broader pattern. Wealthy investors rarely chase quick profits. They build systems where capital multiplies gradually. Return exceeds interest. Assets appreciate over time. Cash flow supports financing costs. And the entire structure becomes self-reinforcing. This is the architecture behind many large fortunes. Not speculation. Not gambling. Just disciplined leverage applied to productive assets. But understanding the mechanism matters more than copying the strategy blindly. Because leverage requires judgment. It requires patience. And it requires constant awareness of risk. Interest rates change. Asset markets fluctuate. Income streams shift. The spread between return and interest must remain healthy. Otherwise, the system collapses quickly. Yet for those who understand the structure, leverage becomes a tool, a financial multiplier, not a financial trap. And the difference between those outcomes often comes down to a single question. Does the asset produce more value than the debt costs? If the answer remains yes, leverage can accelerate wealth. If the answer becomes no, leverage becomes dangerous immediately. That is the quiet secret behind leveraged investing. A simple mathematical spread guiding an entire wealth strategy. Return above interest. Assets above liabilities. Control above ownership. Once you see this architecture, financial behavior across the economy begins making sense. Corporations borrow to expand. Investors borrow to acquire assets. Banks lend because asset value supports the system. The entire structure runs on capital leverage. But only disciplined participants survive long-term. Because leverage magnifies mistakes as quickly as success. And that brings us to a final reflection. Understanding leverage changes how you view debt completely. Debt is not automatically good. Debt is not automatically bad. Debt is simply capital with a cost. What matters is what that capital controls. Productive assets create wealth. Unproductive spending creates burden. The difference determines the outcome. So the next time you hear someone say all debt is dangerous, pause for a moment. The real question is not the existence of debt. The real question is the structure behind it. Return versus interest. Asset control versus consumption. Disciplined leverage versus reckless borrowing. That difference quietly separates wealth builders from everyone else. And once you see that structure, you start noticing leverage everywhere. If this idea shifted how you think about capital and investing, consider sharing it with someone building their financial future. Because sometimes one small insight changes how an entire system suddenly makes sense.